Yeah. We back again.
Okay.
Man.
Yes. Busy week.
Work don't stop, so we don't stop.
Well, yeah. So, yes, very timely episode. If you've been following us, you know we've been doing these how-to series. The last one, shout out to Chris, saying was how to, start investing in stocks.
Mm-hmm.
We've done one on real estate with Matt. We've done technology, artificial intelligence. We've done taxes. We've done how to teach your kids about money, a variety of different stuff. So this one we wanted to go back to real estate, but we want to take it from a different lens. Last time we did how to actually buy a home as far as like mortgages and the financial side of it. But we wanted to do the things you need to know before buying a home. So it's very, very, very important because a lot of times one of the biggest things that I think people are not fully aware of or educated on is what actually happens after, you get an approval for a mortgage, right? There's a lot of expenses. There's a lot of nuanced things that go into play, and you realize it when it's too late. And then it kind of, puts you in a tough spot financially a lot of times because you're not prepared, or you didn't know, or you could have made out better if one thing was done better. So we wanted to have a whole entire live where this is going to go over the things that you need to know before buying a home. So you need to know all of these things, because if not, then you'll be surprised.
Yeah, I think one of those things is like, again, we wish we would have known. I think it's for every level, right? If you're a first time buyer, if you've bought real estate before, rules change, laws change, provisions change. And so you got to stay up to date with this thing. It's not a game. And again, number one, it's going to save you time, but most importantly, it's going to save you money, right? Because sometimes you prepare to get the home and everybody thinks down payment. And there's so many other clauses and nuances, like you said, that that could throw our budget off and we won't even be prepared to have the home, right? We get that pre-approval letter and it's like, oh, I can get this amount. Not so fast. And so we're going to go step by step today to help everybody get on the right foot when it gets to having real estate.
Yeah, so we're gonna get into it, and we have a professional that's gonna walk us through it. Somebody that's extremely qualified to have this conversation. One of the top, when you look at real estate agents, but somebody that's actually built the real estate agency, and one of the top in Atlanta, one of the top in America, Quiana Watson, who's been doing this for a very long time and has sold millions, hundreds of millions of probably dollars of real estate throughout the course of her career. And like I said, actually has an agency with other agents under her. So she's probably the most qualified person to speak about this from a real estate aspect, because that's the whole point of having a professional helping you sell your home or helping you buy a home, is actually they're supposed to be walking you through all this other stuff. So on one side, you have somebody like Matt, who's at the bank, who's giving you the finances to actually buy the home. But then you have somebody that's in the field, that's actually walking the property, that's actually has to do the inspections, that has to, negotiate with the other seller or buyer and earnest money and all that type of stuff. So you got to hear from both perspectives because it's important. So we're going to bring her up. And before we do, don't forget, You Deserve to Be Rich, New York Times bestseller. You can go to youdeservetoberichbook.com. Make sure you get your copy. That's vitally important for your financial journey, for sure.
Fact. Good place to start.
Essential. Essential. Hey.
How are you?
We are great. How are you feeling today?
I'm incredible. Cannot complain. Life is good.
I would never expect anything less from you, Quiana.
For sure. So Quiana Watson, friend of the show. She's done several episodes with us before, live events, Invest Fest, the whole gambit. So somebody that has added a lot of value to not only your clients, but a lot of people online that have gotten information and inspiration from the real estate side, but also, like I said, from the entrepreneurship side as well. As far as I know personally, so a few people that actually have become real estate agents because of you.
Yep.
And not even knowing you, just following your page, you gave them inspiration to actually become a real estate agent. So first and foremost, thank you for joining us. Appreciate it.
Thank you. Thank you for having me. I can't wait to dive into this episode.
Yeah, no.
I feel like it's important information they need to know. It's just so much information online. I think everybody feel like you can use technology and AI, you can chat GPT everything, but you really can't. Like when it comes to buying a property and understanding contingencies, financial obligations, and all those details, that is not a Googleable. That's not Googleable information. You need to have an expert that can really walk you through those details and those layers. So I'm ready to share that and really set the record straight so a lot of people won't be so afraid of home ownership, but understand the value and what to expect.
There you have it. So, all right. So everybody get ready, hit the like button, share. Okay. So as I said, Quiana is going to go. So how we're going to do this, how we've been doing this is that, we have slides. We'll interrupt the slides and kind of ask questions, and then we'll just feed it off from there. But I know that you put together a presentation to kind of go over what you think is important for people to know before purchasing a home. So I guess we could jump right into it.
Okay, let's jump right into it. And this is just introducing myself, who I am, what I offer. I'm glad that you went over that. I do have a real estate company in Atlanta. I have at this moment 20 agents in counting that work with Watson Realty Co. We're here in Buckhead. And we also have great partnerships with developers. I work with a lot of developers to list and sell their properties, but don't be afraid. This particular interview is all about first-time buyers or people looking to purchase a home. I started my career off working with first-time buyers and helping them navigate the process. So I want to make sure you guys understand that. I have a training academy, Agent Tools for Success, where I have mentored several thousands of people across the United States and outside of the country to really learn how to navigate the real estate world. And beyond that, I've gotten plenty of accolades for marketing, sales, recognitions. I do have my master's degree. I clearly understand business, real estate. So I want to just kind of dive back right into this and jump into something that I want to say first, because we always asking, like, what are the things, like, what should you know when it's time to buy your first property? And the number one thing that I think that most people need to know is, before we just jump into it, everybody does not qualify for down payment assistance just because you're buying your first house. All right, let's jump right into it. Things you should know before buying a home. I personally feel like when you're buying your first property, you hear all these stories everywhere. And that story is, I'm going to qualify for some type of down payment assistance. And because I'm buying my first home, the government or some big thing within the world is going to give me money. The truth is that is not the case. You do not automatically qualify for down payment assistance or any type of assistance just because you're purchasing your first home. You need to understand that these programs are designed for people that are in low income to moderate areas. So if you are beyond that amount, or if you have more than a certain amount of money saved, or if your credit score is not at a certain place, you're not going to qualify. So for example, I'm licensed in the state of Georgia. We have what's called the Georgia Dream. Most people look at the Georgia Dream and say, yes, I'm going to use this to buy my first house. Well, the minimum credit score, you have to have a 640 minimum credit score. You can't have more than $20,000 saved. And you have to actually have you have to be in a low income to moderate area. So you can't make above like $65,000 in certain areas. And then certain areas you can't make above $59,000. So you have to really understand the qualifying factors to have down payment assistance. So when you're thinking about buying your first home, I always advise you to start with a real estate professional. We get a bad rep. Oh, they didn't show me the house. They didn't find me the house. But a real estate professional actually has relationships with a lot of different lenders, a lot of different brokers that can actually guide you when it comes to getting some down payment assistance, and then debunk that myth of if you qualify or not. If you don't qualify, then you should be in a position to start saving for your down payment and your out-of-pocket expenses. So when you're looking to purchase a home, I think it's important that you understand your out-of-pocket expenses and debunk the myth that somebody is just going to give you money to purchase your first home. If you do qualify, it's great. You should be able to utilize it to buy your first property. But if you don't qualify, don't be discouraged and get a better understanding of what you do qualify for. So that's just one of the biggest things I feel like I have to tell first-time buyers. Sometimes I have people making over $150,000 a year. Like, hey, I want down payment assistance for my first house. You don't qualify. So you have to position yourself to buy your first home and understand the importance of home ownership.
Yeah, there's a piece there that gets confusing as well, right? Like, what do I qualify for, right? So the down payment assistance is one thing, but sometimes people get these pre-approval letters, and it's like, I'm approved for $400,000. That doesn't necessarily mean you're getting $400,000. I think there's a common misconception that happens around there. Can you clear that up for us?
Yes, the common misconception is they will do an approval, but your approval has to depend on your loan type, right? Certain loan types will go up to 59% or 60% of your debt to income ratio. Some are going to go 40% of your debt to income ratio. But if you understand how you want to live your life, most people have different calculations. Like you deserve to be rich. And I'm sure you tell them about how you may want to live off 30% or 40% of your income. So if you're living off of that, why would you want your mortgage to take up 40% when your mortgage needs to take up maybe 30% or 25% so you can have the other remaining balance to do what? To live and pay the utility bills and save and invest. So I would say instead of focusing on what I'm approved for, make sure you guys need to get what is called a GFE. A GFE is a good faith estimate. When you're talking to a lender, you can go online and put anything in online and they're going to shoot you out an approval. That's a pre-qualification letter. They didn't take the time to understand what your debt to income ratio is. They didn't take the time to have you submit your bank statements, submit all of your income that you're making so they can really calculate what you are comfortable paying per month. So it's not about how much I can spend, it's how much I want to spend. So when you get a GFE, they're going to do an estimate of your out-of-pocket expenses. It breaks down your mortgage amount. It breaks down the amount of money you have to put down, the interest rate at the time. We'll talk about interest rate later, the interest rate at the time. And then it shoots out, okay, based on this is what your monthly payment will be. With the GFE, it helps you to avoid saying I'm approved for $400,000, where you really need to say I'm ready to spend $2,000 a month on the mortgage, and this is how much I need to search for.
Got you.
So it really helps a lot. I think that so many people are thinking, I just got approved for this amount. A lender will approve you for the max. That's their job, is to approve you for the max. It's your job to protect yourself and say, I don't want to spend the max. I have a certain budget of what I want to spend per month. And then you go retroactive with that good faith estimate. And then your pre-approval amount needs to reflect that. And you need to stay within that budget because you don't want to be house poor.
Okay.
So as we move on, I hope that really makes sense for you guys. Too many people are just thinking about the total picture and not understanding home ownership is designed for you to build wealth. But you can't build wealth when you're putting all of your income just directly into the property. So you have a lot of financial responsibility as well when it comes to being a homeowner. So when I broke that down, what is your budget? You know what your budget is. So if you're already paying rent somewhere, which most of you are, and if you're not paying rent anywhere, calculate what you want to contribute towards your overhead. Because you think about a mortgage, your mortgage payment does not include your light bill. It does not include maintenance. It does not include your water bill. It doesn't include groceries. Like it doesn't include what you need to live. So when you work on that, create a very comprehensive budget and don't go beyond that, because you have to plan for the long-term commitment. One thing I always say about buying a property that you have to understand, the purchase price that you use to buy the property is stuck to you forever. You can't renegotiate the purchase price. You can go back and renegotiate what the interest rate is and refinance and possibly get a lower monthly payment. But the way that the economy is going now and the interest rates are going now, who can predict when the rates are going to be low enough to refinance? So always go into it the first time being very cognizant of what you want to spend per month.
Okay. All right. Let's go. I know you have a slide where it's housing related expenses.
Jump to that.
So yeah, let's talk about that.
Yeah.
Okay, guys. So let's just talk about some housing related expenses that you need to include, right? You have your monthly mortgage payment, and your monthly mortgage payment includes your actual mortgage amount that you financed, the interest that you're paying back on the loan, as well as if you have to pay private mortgage insurance, that dollar amount will also be included inside of your monthly payment. You have to pay your property taxes, which is considered your escrows. And your property taxes, that's one thing that does fluctuate. Your property taxes is one thing that fluctuates that most people do not account for. I saw this big thing on TikTok. So let's just address this head on. People are like, wow, my property taxes went up. My property taxes went up so high. No one told me about it. Well, it's a fluctuating expense. And the reason that it goes up if the value of the area that you purchased in actually appreciates in value. So let me explain to you what a value appreciation is, so you know. No, you may not like increased property taxes, but why it benefits you in the long run. If you buy a property for $500,000, and in 2 years, that house is now evaluated for $600,000. 500,000 minus that from 600,000, you have $100,000 in equity. That means your home is now worth an additional $100,000 from the time that you purchased it. So when the tax assessor goes back out to the property and assess your values, they're going to increase your taxes because now your home is valued at more. That benefits you if you want to do a couple of things. One, let's just say you suddenly need to sell your house and move to New York. You know, you want to just hang out with EYL. If you need to sell your house and move from Atlanta to New York, you put your house on the market, you have that difference in equity, and you could actually try to make the numbers in the market, sell it for $600,000. After agent fees, you'll come home with probably $70,000, right? That is what equity is. That's why it's so valuable. But if you just hold on to the property and in a couple more years, you want to actually do a equity line of credit, a home equity line of credit, where you say, hey, bank, my house is now worth $600,000. I need $50,000. Can I leverage this house and get $50,000 to start my own business? That is why equity is so important. So yes, your taxes will go up because they fluctuate, but getting home equity is something you should be proud of as a homeowner. Who wants to buy in an area that's not appreciating? That defeats the purpose of home ownership.
So here's the question inside of that, right? Because a lot of people will be doing renovations on their home, they're upgrading their home, right? How often is the tax assessor coming, right? Is it every 6 months? Is it 1 year, every 2 years, so that people can prepare? Because a lot of times people will allocate their budget based on what the property tax is now. Obviously, as you do improvements, that will go up, hopefully, if you're in the right area. How often is that guy or that woman coming?
They don't actually come out to your property. They look at what has been sold in the area. So you're thinking about a tax assessor. It's all digital. They're just looking at what has been sold in the area. So if your neighbor sells their property and they did some upgrades, it's going to affect you. They're going to look, oh, so this house actually just sold for $700,000. We have no idea what you did inside of your property, but what we're going to do is say, now this entire area is worth this dollar amount. So when these things happen consistently, the only time someone is going into your property, and I don't want to get too ahead of the game, is when you get an appraisal. You guys know what an appraisal is. So an appraisal will go into your property when you're ready to sell your property, or as a homeowner, if a home buyer, if you're ready to buy a property, your lender will not give you any money. There is no lender in the United States of America that will lend you money without you getting an appraisal. An appraisal is a third-party company. So no, you can't just say, I'm calling my friend, that's an appraiser, and they're going to come out and tell me what this house is worth. That's not how it works. A lender will assign an appraiser to your actual file. The appraiser goes out and they will compare the condition of the property that you're interested in purchasing to 3 other properties that have sold on the market. When you get your appraisal back, they're going to measure the square footage of the home. They're going to look at the condition. They're going to look at market conditions. And then they're going to tell you, let's say you place an offer on a house for $500,000, the appraiser is going to say, hey, this house is worth $500,000, which is great. Or they're going to say, hey, you got a deal. This house is worth $550,000. That means you have instant equity. Or if they come back and say, this house is only worth $475,000. Let's just say that does happen. That means it's coming in below the actual price that you said you would purchase it for. That is your agent's responsibility to submit an amendment to reduce the purchase price, a copy of the appraisal, and advocate on your behalf to say they're not going to pay the difference. The lender is not going to pay the difference. And I'm only going to buy this property for what it is worth. So that kind of leads into why you need a real estate professional. A lot of times y'all don't understand the contingencies, when you're supposed to get money back, what you're supposed to do. And that's what happens with an appraisal. So all of that kind of leads into like your taxes. But to further answer the question, yes, it is important that your home is appraised at value when you walk in. So that way you can have appreciation and equity when you have, in the instance you're trying to get out of it.
Yeah. So let's talk about some of these other fees, right? Because we know about the mortgage. Some people know about the property tax. We know about homeowners insurance, but there's some other fees that.
But wait, but before we go to another slide, so because we didn't, I just want to make sure people get the whole thing. So can we go back to the slide? The
Let's
other
do it.
one?
Yep.
So utilities is a big one because this is why a lot of people's using, different type of energy efficient things for their homes, and that can save a lot of money, right? And even setting up utility a lot of times is a process, water, gas, all that type of stuff. And then, of course, the homeowner's insurance. But the homeowner's insurance is vitally important now, especially you look at California, fires, you look at Florida, you look at floods. So, okay, the taxes, we just talked about that. That's important. The mortgage is pretty going to be straightforward as far as on the bank side. You should understand those terms. But this homeowner's insurance and the utilities, can you talk about that? Because that's something that people need to really have an understanding of what they're getting themselves into before they actually get the home.
Absolutely. So let's jump into utilities. If you're looking for a single family home, it would be ideal, and I want you to write this down. Oftentimes, agents don't do this. Ask the previous homeowner to provide you with a statement of what their utility bills are. Like, what are they paying on average for their light bill? What are they paying on average for their gas bill? Those are two controllable expenses that you don't really consider when you're buying a home. Why is this important? Let's just say you're buying a 5,000 square foot home on a basement. And you're coming from a 2-bedroom apartment that's maybe 1,300 square feet. The difference in the amount of heat that's required to heat that space, the amount of HVAC that's required to cool that space, it could be almost the cost of, it could really be thousands of dollars. So while you're out here assessing what your expenses should be, ensure that you get that information from the current homeowner before making your purchase. So utilities are such a big deal. And then when we talk about homeowners association fees, so you guys are in New York. So a lot of times you guys are buying, not y'all, because you deserve to be rich. But a lot of people are buying condos, townhouses, things like that. And there, a lot of times those fees are included. So you get into an HOA, they'll say, here's an additional. I saw a condo here in Atlanta where the HOA fee is $1,400 a month. But it includes the utilities, and then it includes amenities. So it kind of offsets, but you have to understand how that will affect your monthly payment. So HOA fees is a huge deal. I think we get a big bad rep. I don't want a house in the HOA. It's good to it and it's not so good. The good parts of an HOA is if you are in a neighborhood, a single family neighborhood, and everybody has to maintain the exterior a certain way, everybody has to maintain the grass, their yards a certain way, it actually helps with your value appreciation. You're going to hear me say value appreciation a lot because I want you to understand that is the number one reason for getting into real estate and owning a property is value appreciation and ownership. That's it. So of course, HOA fees is something you need to consider and see what is included in that. And then routine maintenance. I most recently was consulting with someone and they have to get an entire new HVAC system. They got a quote for $20,000. You can't call the landlord. You are the landlord. You are in charge of those fees, of that maintenance. So getting routine maintenance on your property and accounting for those additional expenses. I hate to scare people. Everybody has this scare tactic. I'm going to tell you, and this is not even look into any type of home warranty companies that offer complete protection. So when you get a home warranty company, that helps you with the routine maintenance. So instead of you being responsible for that $20,000 fee to replace the system, if you were paying a monthly fee into a home warranty company, then you could call them the same way you would call your landlord. Why do I want to say this? Because I'm sick of people trying to scare people into not owning a home saying, my landlord can pay for that. Well, if you were paying a $50 fee per month and your HVAC system went out tomorrow, you would be able to call your home warranty company to cover it. So don't allow these expenses to scare you, but be very aware that these expenses are there. So your job is to protect yourself. So again, unexpected expenses are going to happen. You're going to have to get your gutters cleaned every year. You're going to have to get your exterior of your property pressure washed every year. Some people do it every quarter. You have to consider that you want a home inspector to come inspect your property every single year, not just when you buy the home. When you initially buy the home, you do get a home inspection because you're negotiating with the seller for any defects in the property, and you don't want to purchase a property with a defect. But what happens when you live in a home? There could be underground leaks that you are not aware of that continue to happen. Your HVAC could be at the bottom of, like at the end of its lifespan. So you get a home inspection every single year. That's about $500 to $600. But what it does is preventative maintenance. That preventative maintenance, now you can call your home warranty and your handyman to address issues before they become too expensive. No one talks about that type of maintenance, but that's what it requires to maintain a home. So outside of that, you have the utilities, you have the just maintaining the integrity of your property, but then you also got to account for certain things. And I'm going to focus on single family homes because it's completely different maintenance than having a condo. A single family home, you may want to take into your budget, at what point do I have to replace the roof? An average roof span is 15 to 25 years. So you have to think about that. At what point do I have to replace the HVAC system? They keep changing the Freon and different things in the HVAC system. That's typically 5 to 10 years. Some of them are saying 20 years. So what you want to do is budget that, and I will not stress this enough, get a home warranty, and then make sure when you purchase your property, you're getting scheduled and consistent maintenance of your home. That is how not.
There's a part here, like we talked about the homeowner's insurance, but most people don't know about mortgage insurance. And I'm assuming if a lot of people are being first-time home buyers and they don't have the 25% down payment or 20% down payment, they're going to fall in this category. So talk about what that is and kind of give it like an explanation of what mortgage insurance actually entails.
Yeah. So mortgage insurance covers the lender. Mortgage insurance does not cover your property. It covers the lender in case you default on the loan. So when you're paying mortgage insurance, a lot of people are like, do I have to pay it? Yes, you have to pay mortgage insurance unless you're putting 20% down. If you're putting less than 20% down, at some point though, what does happen, you do pay the private mortgage insurance, but at some point when you have invested more than 20% towards the principal of your mortgage, you can actually call your mortgage lender and say, hey, I have invested this much. I want the mortgage insurance to come off. The mortgage insurance will not cover your house if it's damaged. The mortgage insurance doesn't cover your house, God forbid, if there's a fire. It only covers the lender because the lender is taking a chance on you because you don't have enough skin in the game. You have enough skin in the game for them to say, hey, we're going to give you this mortgage, but you're putting less than 20% down. So we need insurance on top of what we're giving you, just in case you default and you cannot satisfy the loan. That is what mortgage insurance is, and you can't get around it.
So what's some best practices as far as for the homeowner's insurance, right? For the homeowner's insurance, what's best practices that people should be aware of when getting a homeowner's insurance policy?
You get what you pay for. Cheaper is not always better. And I feel like oftentimes when you're shopping with different home insurance companies, and I have great relationships with homeowners insurance companies, you're just thinking, this is going to affect my monthly payment. It is. They take the calculation of what it will cost you for 12 months, and then you're paying on it every single month as a part of your escrows. Your escrows include your insurance and your taxes, right? So when you're thinking about, okay, I have to pay this amount, I would say shop and tell them the truth. If you have 3 Rolex watches in the house, right, and you just did an upgrade in your kitchen and did soft close cabinets and Wolf appliances, you need to tell your insurance company about this, because what happens is you're getting insured at the house. Let's say you buy a house with, GE appliances. You're just happy to own a home. You read the book, I Deserve to Be Rich. You do a stock option play, and now you want to renovate your kitchen. You go and do this whole renovation. It's $100,000 renovation, and you don't report it to your homeowner's insurance company. What happens in the interim if your house catches on fire? Like I said, like what happened in LA and things like that. If you never paid the difference in that cost, it's not covered. So that's why keeping up with your homeowner's insurance and making sure that you tell your preferred insurance agency the truth about your assets. They can understand how much it will cost to actually rebuild the property, because there's different levels to insurance. Cheaper is never better. I will always say be educated about the level of insurance that you receive. So in case something happens, because that is what insurance is for, you're covered.
And then also it's important because they had a study that like I think 30% of homeowners actually they're paying more money in all the ancillary stuff than the actual mortgage. So you got to have a budget. You got to have an idea of how much money you're going to spend, because if not, if your budget is like $2,500 and your mortgage is $2,000, and you think that I got a $500 surplus. But then when you add all these utilities and the taxes and then the insurance and then, maintenance, upkeep, and the budget is actually your $2,000 a month mortgage actually turns into $4,500 a month that you actually end up spending. That causes a lot of problems.
Mm-hmm. Yeah. And one of those taxes that I didn't even see in there is school tax, right? Like everybody wants to live in a great neighborhood and go to the great school. Well, that costs. And so that's something that's getting paid semi-annually or sometimes quarterly. So just keep that in mind. Like when you want to move to that great neighborhood because it's a prestigious school, the people that own property there, they're paying school taxes, which is another amount that you're going to have to put into that budget that you apparently thought you had when you were starting the buying process.
Oh, and this is one thing I want to tell you guys, that I'm a professional, right? So it shouldn't have happened to me, but it happened to me too with homeowners insurance. One of my investment properties, I'm just like, why is this monthly note so high? What happened, right? I did put down 20%, so I just pay yearly. I pay annually, and it slipped my mind to renegotiate the terms of my homeowner's insurance policy. So they increased my homeowner's insurance policy beyond the limit that I was comfortable with. So always remember, you have to advocate for yourself. And every year when it's time to renew that policy, you do know you don't have to be stuck with who you started with. You can actually shop around, let them know you're shopping around, shop 3 different people, tell them you're shopping, get the lowest rate, and then get the lowest rate that has the highest coverage. Let me say it one more time. Get the lowest rate that has the highest coverage, and that will help with controlling your overhead expenses.
Vitally important. Vitally important. All right. So how do we avoid overextending ourselves?
Stop trying to keep up with the Joneses. I'm serious. We have to stop. You're probably going to look at my page and say, who is she to talk? All she posts is these multi-million-dollar properties. Well, that's how I started. That's not how I started, and you got to understand your first home, depending on who you are and where you are in your life, may not be that multi-million-dollar mansion that you want, but that starter home will set the foundation for you to get to that next level. So assess your budget. There are so many rules about how much you should save, how much you should live off of, and how much, you should invest in just your overhead expenses of living life. So what is your budget? Is it going to be the 30% rule? If it's like 30, everybody has a different rule that they live by. I saw someone that said they're living off 30% of their income. They're investing. Do you hear this? They're investing like 40% of their income. And then they're just saving the remaining balance. So assess your real budget and don't go beyond it. And I would say add a contingency of about 5%. So if you think you can live off 30% of your income, reduce it to 25%. That way you can account for inflation. We're living in the day and age of inflation. We cannot control the cost of gas, groceries, and living expenses. Next up, have an emergency savings. Have an emergency savings because things can happen as a homeowner. Like as a homeowner, you are responsible for for any of the overhead or any expenses to maintain your property. So make sure you have enough money to save and just consider the future changes that you may have in your life. So don't always think that this is going to be where I always am going, where I start is where I'm going to finish. Real estate is nothing like that. You can start with a townhouse that's affordable. You can live in that townhouse. You can start with a multi-family home, which a lot of people like to house hack, that is affordable. Live in one side, have the other side covering the mortgage. And then by the time you're ready to move on to your next level because you have invested in a business or you've gotten a promotion at your job, you can now elevate to the next level by selling that property, leveraging it as a rental, and build your wealth and not feel so, build your wealth and not feel like I'm behind. That is why most people over leverage. You feel like you're behind and you're not. If you just bought one property, you're ahead of most of the people in the world. So just buy that property and don't worry about keeping up with the Joneses.
That's a fact.
That's good information. Okay. All right. So then we have to understand the cost of home ownership.
Oh, yeah.
Vitally important.
Yes. The cost of home ownership it depends on the program that you get, right? There are so many different loan programs that are available. So let's just go over them. You have FHA financing, which is the most popular financing. That financing requires 3.5% as a down payment. However, Your one-time cost is going to be your down payment, and then you have closing costs. Down payment, closing costs. So when you're getting a loan, FHA financing 3.5% down. You have conventional financing, which is 20% down, 5% down, or 3% down, depending on the program that you use. You have VA financing, which is 100% financing. I'm only talking about the down payment. We're not talking about closing costs. So those are like the three different financings that you can use. Then you have one-time costs. Those one-time costs are your closing fees. What are closing costs? Closing costs are the costs for them to run clear title on your property. You're paying attorney's fees. You're paying any HOA fees, any activation fees. That is what goes into your closing costs. And they can typically be between 2 to 5% of the entire purchase price of the home, right? Your home inspection fees, you have to pay that. You're still going to pay for your home appraisal. Your home appraisal is ordered through the lender, but you pay out of pocket for a home appraisal. And then you have to pay your moving expenses. Of course, you're going to have to move, transfer, and get utilities in your name, and maybe hire a moving service unless you're going to hire some of your friends, right? But the ongoing cost of home ownership is property taxes, and they will go up. Property taxes is something that's ongoing. Another ongoing expense is going to be maintaining the property. Maintenance of the property is something you are responsible for as a homeowner. You are always going to have to pay for homeowners insurance. That is ongoing expenses you are responsible for as a homeowner. And of course, the mortgage, because if you don't pay the mortgage, the bank is going to take the home back. So you're being foreclosure. So when you're thinking about the ongoing expenses and then the one-time upfront expenses, be prepared to handle both.
Well, let's also talk about, I skipped over one important one, the DTI, the debt to income ratio. So let's go over that if we can.
Yeah. So most people think like, how do I get approved for the mortgage? It's how they calculate your debt to income. Your debt to income is how they're going to say how much more money, how much more debt can we approve you for? Because getting a mortgage is a debt, but it is a good debt, right? So to calculate your debt to income ratio, you need to take your monthly recurring debt payments. So let's just say you owe, I'm going to make it simple, $10,000 in student loans, but you pay $100 a month. So you got that $100 a month that you're paying. Let's say you have a $300 a month car insurance, car payment that you're paying. So recurring bills are what they count to your debt to income ratio. And then you divide that by your monthly income. And when you make that division, that is how much they say, okay, this is your calculation for your DTI ratio. And then they input that in the system and say, well, based on this amount, we can approve you for this dollar amount. That's how you get these automatic approvals. But you still need to remember, get a GFE, a good faith estimate. Make sure a lender does not have you just out here with the pre-qualification and putting your hard-earned money at risk. And let's just say you've paid, people are paying earnest money, they're paying for home inspections and appraisals, and then a lender never did the detailed work. And when they do a deep dive into your file, now all that money is wasted because you technically don't qualify for the loan amount. So it's better to do all that up front. Submit your paperwork up front. Be transparent about your income, your debts, so that way the calculation makes sense and you don't be house rich and income poor.
But then also it's important to do your own as well, because especially if you come from renting, like if you rent an apartment for $2,000, you pay $2,000. And nowadays, even a luxury apartment, like before, you used to have to pay first and last month rent. But like with the luxury apartments now, you just pay $500. So you pay a security deposit for $500 and you get the apartment. Now you got to pay the electric. There's usually like some like kind of maintenance fee, trash removal, like $150. But what I'm saying is this: if you get approved for $2,000, if you get approved for the mortgage, that doesn't mean that you can actually pay that mortgage, right?
Exactly.
You gotta factor in all those other things. If you live in an apartment, you're not going to be paying an additional $2,000, but you could be paying an additional $2,000 as a homeowner. So if you go into it and you just thinking from like a renter's mindset of like, okay, the mortgage is $2,000, I'm going to pay $2,000. I might add a couple of hundred in for, you might have to add an additional $1,500 in. So if you look at it from that standpoint, like the bank, even though the bank gives you this approval and says that you're qualified for this, like you should do the numbers on your own as well to see what the real cost is going to be every month, because that could be something that, can really put you in a bad financial situation.
Yeah, we talking payments like for mortgages and insurance. That's not even including like you have to live, right? And you may have children, and you may have credit card debt, and you may have student loan debt, right? Like all those things have to be taken into account. And so it's important before you make that decision to make sure that you lay this all out. The next thing obviously is your credit score. So like that's important for a multitude of reasons. I think everybody understands that. So imagine this, right? Like I know my credit score, right? I've been trying to get this down payment. 20% has been the number, but I can't really get to the 20%. It's tough for me to pay my rent, pay my student loans, all my debts, and try to save to get to 20%. What are some of the procedures or some programs that I can, if I don't have 20% down, to buy this home?
If you don't have 20% down, I would say you first want to figure out what mortgage type you could be approved for. There are conventional financing programs that are really good programs. In there's a 3% down home ready program that they could qualify for. That is a conventional loan product, or you could do a conventional product that's 5% down. You're putting 5% down, but just keep in mind, you're going to have to pay that private mortgage insurance again, because they're taking a risk on you. But if you're in a position where it's like, I cannot save 20% down, but I have saved quite enough, you need to meet with a lender. And I say this all the time. People are so afraid if they pull my credit, then my score is going to go down so much. Throughout the process of buying a home, they're probably going to pull your credit 3 times. So if your score, your credit cannot handle a one-time pull to prepare you, then you're mentally not ready for home ownership. I would tell them to give you what is called a home ready plan. So when they do a home ready plan, what is that? Tell your lender, listen, I want you to give me a home ready plan. In a home ready plan, they're going to run your credit. They're going to assess all of your income. They're going to do your debt to income ratio. They're going to talk to you about how much you want to spend per month. And if your score is not where it needs to be, they can do what is called a rapid rescore. A lender has the options to do a rapid rescore where they'll tell you where you could focus your energies. Like maybe you're paying debt down, but you're paying debt down to a credit card or to a space that doesn't affect your score going up. But a lender will tell you exactly where to allocate those funds so they can get your score exactly where you need it to be, and then connect you to the right loan program. You think that it's just one person. No, when you're working with a mortgage broker, they're shopping your profile to several different lenders that are willing to take a risk on you, and then they'll understand your buying power. That is how you empower yourself. You empower yourself by taking the first step. You can do as much as you want to in the background, but if I were you and you have at least $25,000 saved and you feel like I can't get further and I have like a 620 credit score, but buying a house is on my goal list, now is the time to consult with the lender, because home prices are not going down. We see that. So if you can get in early enough, that helps you, because but negotiation power is high. So you can negotiate. I just ran some numbers. And again, I can only speak for the Metro Atlanta area, but I have agents in every city, especially New Jersey. I got a lot of agents in New Jersey, and they are telling me they're able to leverage and negotiate and get more concessions from the seller, and actually are getting more people to reduce the asking price because there are not many buyers on the market right now, right? So you can leverage that to reduce your out-of-pocket expenses. And when you get a seller concession, what is a seller concession? Let me tell you. A seller concession is saying, in exchange for you purchasing my property, I'm going to contribute this dollar amount towards your closing costs. And that reduces your upfront out-of-pocket expenses. So, and typically, depending on the loan type, they can go up to 3%. As a reminder, they cannot go above 3% of the purchase price. Even $1 above it, they have to reject it from the lending standpoint. So when you're leveraging the negotiating power, you're the out-of-pocket expenses, and you're reducing the cost to purchase the home. Even with interest rates being where they are, when rates go down a point, my rule is at least 1.5 points, because you'll see a difference. If rates go down 1.5 points, call your lender, refinance. Now you're able to get a lower monthly payment, even lower than you already allocated, but you've already used all your leverage to negotiate the purchase price, which will never change. And then the reduction of out-of-pocket expenses, which will never change. That is how you win in today's market when you are a buyer.
No, that's good information, because you said all this stuff is stuff that nobody really knows. You just go and buy a home and you just wing it. And a lot of times, man, it puts you in a lot of trouble. Even could cause somebody to foreclose on their home. Let's talk about the different types of loans, if we can. I know it is.
Absolutely. So there are technically, there are different loan types. You have FHA financing. FHA financing is really kind of put together for, it's like really designed for first-time home buyers, but you can be a second-time home buyer and use it. You can have low credit scores. You can have a low credit score as low as 500. I've seen people offer the program, and your down payment is 3.5%. Now you can put down more. That's the part people don't know. You can put down more, which will affect your monthly payment, but typically you can put down as little as 3.5%. They actually are a little bit more lenient when it comes to your debt to income ratios, and you can use this loan type to purchase a home, a multifamily up to 4 units. So FHA is the most popular loan type for first-time home buyers. A lot of the down payment assistance programs that you heard me speak of, they're attached to the FHA financing. So I would encourage you, if you are a first-time home buyer, meet with the lender, get with a professional, and find out what your full picture is and what you're approved for. So that's one loan type. The next loan type is going to be conventional financing. Conventional financing is the traditional financing, and there's several different conventional financing. Most people are using conventional financing to purchase their homes. They have the Home Ready program with as little as 3% down. You have your jumbo loans, and a jumbo loan is a loan where you're absolutely more than likely putting 20% down. You're buying a home that is actually higher than what they will allow you to loan on. And so you get jumbo loans within a conventional financing program. You have a 5% down payment in the conventional financing program. They actually have a higher credit score minimum, but it works best for people with strong credit. And you are going to have the option, if you put 20% down, to not have the private mortgage insurance. So that is why when you're doing a FHA loan, you have to have private mortgage insurance. You don't have a choice, right? Then another loan type is going to be your VA financing, and this is for veterans. If you're a veteran and you're looking to purchase a home, they have lower credit scores, and as you can see, it's about 580 on the credit score, but you have no down payment. You're only responsible for the closing costs. That's right. No down payment. Let me say this one more time. 0 down payment. You're only responsible for the closing costs. But what happens is when you're getting a conventional loan and you have to put 3% down, you pay that at the closing table. The VA financing says we're going to do no down payment, but there is a funding fee. But the funding fee is wrapped into the loan, so you don't have to pay it out of pocket, but you're still responsible for your closing costs. So keep that in mind. And this is only for military veterans. So I really think that the VA benefits in the VA loan is underused. I'm from Fayetteville, North Carolina. It is a military town. I think that anyone that served in the military should use their VA benefit. You deserve it. You worked hard for it. It's the only financing that is giving you 100% financing, a very lenient back-end system, and you're able to get in with very little money out of pocket. And that is the goal. As little money out of pocket up front as possible, so you can become a homeowner.
And this loan is for primary residence, correct? This is not
Correct.
like investment properties.
Oh, yeah, primary residence. It's your primary residence.
And quick question, when you talked about the jumbo loan, seriously, what is the threshold? Because I feel like obviously it changes over time. What is now the threshold for a jumbo loan? What is the amount that you have to have in order to qualify?
It just depends on the lender. Jumbo loans, they shift, right? So when people say I was approved for a loan, right? It depends on your lending. So let me give you an example. I closed a deal in December. The house was $3 million. But the lender, based on the risk and the profile of the client, was like, we're only able to lend them based on what? Their debt to income ratio and their profile, 2.5 million. So the difference between 2.5 million and the 3 million, they had to bring $500,000 to the closing table. So a jumbo loan is when you're buying homes that are multiples of millions of dollars. And depending on the risk that you are, the lender is going to shop that around, but you are always going to at minimum put 20% down no matter what on a jumbo loan, but it could be more depending on your profile and your debt to income ratio, because the lender is the one taking the risk on that jumbo loan. So your state, your state you're in, that fluctuates how much you can qualify for a jumbo loan, because they take into account, like California, of course, the lending is higher. New York, the lending is higher. Atlanta, they're going in alignment with what the lending should be here. Then your credit profile, and then what? Your debt to income ratio. That is how they calculate it.
And then, okay. So going off script, let's talk about some things like, what is best practices to negotiate? Like if somebody's buying a seller, because I know there's earnest money. Sometimes you can negotiate different fees and stuff like that. So what from a negotiation standpoint, what are some things that can be negotiated or at the very least looked at when purchasing a home from somebody?
Let me break down what the buyers are responsible for when it comes to buying a house. I think that really helps. Let's start with number one, with this new settlement from the National Association of Realtors. What has happened is, and this, we didn't speak on this enough, but we need to. People used to say, hire me as your buyer's agent. My services are free. And now with this new lawsuit, the services were never free. The sellers actually did a lawsuit against the National Association of Realtors saying, listen, when we sell our property, we're paying for seller agent representation. So when a buyer is in the field looking to buy a property, they should pay for their own buyer agent representation. So now you are responsible for the compensation of your buyer's agent, unless your buyer's agent can negotiate it from the seller. We no longer advertise or market. Like when I list a property, I'll say, well, I'm going to pay a buyer's agent this percentage in order to bring me a buyer. We can no longer negotiate that. So you're responsible for that. And typically that fee can be up to 3%. So how do you negotiate? You let a buyer's agent know, listen, I'm only willing to pay you whatever that percentage is. And you sign a buyer compensation agreement agreeing to that price, but also they are going to advocate for the seller to pay their compensation. So that's going to be the first thing that you need to actually negotiate. Secondly, you can save money. I personally don't feel like you should. Your energy is best used and is negotiating the seller to contribute to your closing costs. When you're thinking about earnest money is actually applied to your bottom line numbers when you get to the closing table. So if you want to win an offer and you like, listen, as long as I have an agent that I trust, and I can just say this, I have never lost a client's earnest money. I know the dates, I know the timelines, I know the rules.
This happened with Jada. You familiar with this?
I know exactly. Let me be as vague as possible, and I can't be messy in Atlanta. That was not my deal, but I can tell you what
I'm saying. Well, she said it publicly. That's why I'm speaking about it.
I know. Let me tell you what happened.
Yeah, all right.
What happens is this: there's contingencies to the contract. So when you saw that Jada lost her earnest money and she didn't want to move into the property, there are contingencies. So a contingency is the timeline that you have to meet that all parties can use to get out of the contract, specifically the buyer. So when you submit $25,000 in earnest money let's just say for a contract, you have a couple contingencies. One, you have your due diligence period. A due diligence period in the state of Georgia, and most other states do have this, is your time period to inspect the property and negotiate repairs prior to moving on to the next contingency. So if you have a 14-day due diligence, within that 14 days in the state of Georgia, again, keeping up, and other states do have this too, if you get a home inspection, you get a roof inspection, and you come back and say, hey, seller, I did not like this inspection. I want you to make these corrections prior to closing. And your agent puts down those corrections. If the seller does not agree to it, you can terminate your contract within that due diligence period and get your money back. Once you pass the due diligence period, then you have the financing contingency and the appraisal contingency. The financing contingency is the time period that the lender has to provide a letter of commitment to the loan. So when you first get your mortgage approval letter, that's an approval. But they have to now take the actual binding contract that you signed, and now they start submitting that binding contract along with all your other documents to an underwriter, and an underwriter will come back and say, this is a letter of commitment. We are committed to actually funding this property. Then you have your third one, which is your appraisal contingency. And we spoke on that. So in that appraisal contingency, if the home does not appraise at value, then your agent needs to do an amendment to reduce the purchase price. The seller does not, let me say this again, the seller does not have to agree to reduce the price. They do not. So if you paid for a home inspection and you paid for the appraisal and the seller say, I don't care what your appraisal said, my home appraised at this value, you can terminate the contract and you can get your earnest money back. But all the other expenses that you spent to purchase the property, you will not get refunded to you. So in the case of Jada, I think it was a little bit of buyer's remorse, probably when she was under contract to purchase a property. And I think it was like, thinking about the exposure, of buying that property. I think it, this is what happens when you buy a property. You need to work with an experienced agent that understands how to protect your privacy. So you should, if you are a celebrity or a semi-celebrity, we have this issue all the time. And I hate to say it, especially when you guys are working with us and we're very social on social media, people, and that's how we get our business. But when you're protecting the best interests of your clients, the number one thing they should be doing is purchasing the home in the name of an anonymous LLC, or they should also be buying it in the name of a trust. And then the second layer that you need to add, I have closed plenty of deals that y'all know about that nobody else will ever find. Get it out of my name, because anything that I sell is public knowledge. So what I do is I don't close the deals under my name. I close it under the name of the other agent on the other end. So when someone comes to my page and try to see who she worked with, they can't find it and you can't find them. And I think she had an issue with her privacy being exposed. She was afraid of actually closing on that property because she is a single woman in Atlanta. And I don't think that she felt comfortable. So she passed all of her contingencies. So she should have made that decision for the state of Georgia, within her due diligence period. You can terminate for any reason. You can wake up and say, I just decided I don't want this house, and you get your earnest money back. It doesn't have to be a reason in the state of Georgia. She passed that contingency, then she changed her mind. And her agent should have explained that to her. Like I always explain, as soon as your due diligence period comes, the day before you get an email, this is the last day to terminate. Do you still want this house? My team calls, do you still want this house? Otherwise, when you pass this one contingency, the only way out of the contract is what? Financing or appraisal. So she passed the contingency and she changed her mind, and that's okay. But you got to do that within your due diligence period. That's why it's important to take your time when buying. And also, if you are a public figure, take the time to make sure the person that's representing you understands how to protect you, because I got to just say this, as a minority business in Atlanta, I see it happen so often. We're popular. I'm popular. And then I work with other popular people. And there's so many other people that are minorities too. We want to get the luxury business, right? But we can't put them out there. We got to be comfortable with our names being in the rooms instead of our blasting their addresses and their personal information all over social media, which is probably why she ended up having the remorse she did have. And she got out of that and she decided to terminate the contract because she wasn't comfortable. She did subsequently end up buying something after that, though. And I think they followed those rules and it made her more comfortable.
So let's protect each other in terms of inspection, because you brought this up and this is important. Mm-hmm. If I'm looking at a property, some of the things you can see with your eye, right? Like I can see like the roof may need to be repaired, but then there's some things that you're not going to see. So what are the questions that we should be asking while inspection has happened? I'll give you a prime example. I'm in a home right now. My plumbing, right, to the city line had a belly in it, right? Mm-hmm. That repair cost me over $20,000, right? That's not something I can see with the naked eye. So what are you telling clients as you're going to inspection, the questions that you should be asking? Obviously, age and condition is important, but what are some other things?
There are different levels to home inspections, right? So let's just say you're buying a new construction property, you can just literally get the general inspection of the property. But if you are buying a property that is a little older, you need to get a home inspector, you need to hire an engineer, and you need to hire a plumber that will actually inspect the pipes that actually go from your house to the road. When you did do an inspection from your house to the road, because that's what you're responsible for, then right where I know exactly what you're talking about, and we're right where the city is responsible, before you're responsible. If it's on your side, you have to pay for the repair. If it's on their side, they have to pay for it. But because you probably just did the general home inspection, it was missed because you need to actually do, though it costs a lot of money to buy a house. So especially if you're getting an older home. So I'll have a whole list. You can get an individual roof inspector, a plumbing inspector, a general home inspector, a HVAC inspector. So when you're getting all these inspections, it can cost you up to $1,500, but it protects your best interest in the long run. Whatever you don't do up front, you pay for in the end, as you're seeing for yourself. Had you paid for that inspection for the plumbing, where they use one of those lights to go down the plumbing hole, you would have saw this and you could have negotiated this with the seller prior to closing.
What do you say about a real estate attorney? How important is that, and how do you get the right one? Because then you got to look at looking at the land and doing like the geological test on the land and stuff like that. So that's important as well, right?
Yeah. So if you're looking to purchase land and doing geological tests, keep in mind every state is different. So where you all are in like New York, the attorneys negotiate the contract. In Chicago, the attorneys negotiate the contract. Here in Atlanta, the agents negotiate the contract. Our closing attorney doesn't come into play until it's time, until we're under contract and they're just running clear title, right? So how important is it to hire the right people? So if you're getting land and you know you're buying land to build a home, then you need to hire an engineer. So that way someone can actually look at the land. And you should also, you should know, hopefully, you know, if you're going to build, you know exactly who you want your builder to be. So they can do the soil test, or you can hire someone to do the soil test. And then also make sure that whatever you want to build on the lot, the setbacks, that it's also set up, the setbacks, understanding what you can build in the area. That's when it comes to actually hiring a professional. Your attorney is not going to know that information. Now you can order your own survey, but 9 times out of 10, the average person doesn't even know how to read the survey. They don't know what they're looking at. But if you hire the right people up front, I feel like what happens is, again, this is Google University. It's like, oh, I could buy my own land. And then you get the land, you do the soil test. Now the house that you wanted to build, you can't build on because you tried to save money up front by not hiring a professional. And now you got to go back and hire a professional in the end.
You are preaching right now. Topography reports, I didn't realize was so important. And even when you're buying a home, right, you think you can build things that you want on the land, and it's like, well, you got to get permits for it. Like even the permit process. Talk to people about that. I don't think people really understand that process, right? You need a permit to do everything. Yeah.
I think that we have to realize that there's a reason that there are people that have dedicated their lives to doing those jobs. So you buy this land and you're told that you can do an ADU, right? So I could just build me a little house in the back of my house because I got all this land. And then you go to get the permit and there's like, well, we're zoned this. And now you got to get it rezoned for that. And they're not trying to help you because they work for the city. They just like, here's the paperwork. Let me know when you get it submitted. Before this is what you should be doing within your inspection period. This is why you should be, if you know that you are buying a property and you got 4 acres and you want to build a pool and you want to do an ADU, you should hire a general contractor to walk you through that process, pay them their fee, whatever that fee is. So that way you understand where you are and what your limitations could or could not be on that property. You can't just get land and start building. It doesn't work like that. I mean, we wish it did. It doesn't work like that. Not in the state of Georgia, not New York. Now, there are certain areas that don't require GCs, like Texas. Texas has different zoning laws, but they still have processes. And I think the best way for us to avoid the pitfalls of buying land, thinking we can build whatever we want to do, or buying land to build a big house and then not getting your own inspections. I represent developers. But I can tell you right now, if I was buying a house from any person, I don't care what developer it is, if I'm buying land, I'm getting my own soil test with my own engineer. I don't care what you give me. I'm getting my own survey with my own surveyor. I don't care what you give me, because you have to keep in mind, you're the one responsible for paying the mortgage, not them. This is your asset. So why are you putting it in the hands of someone else? You should always make sure that you're financially prepared to invest in yourself and in your own knowledge and in the own paperwork you need. So in the event it doesn't work out and you're within your due diligence period, you can terminate and move on and get your earnest money back.
What are some red flags to look out for if somebody's buying a home?
Ooh, I would say the number one red flag to look out for is, one, when you're walking into the property, make sure that you take a second just to look into the utility closet. Kind of look at it. You may not be an HVAC tech, but I can tell you water should not be dripping down from anything. So check into that. If you have an opportunity, turn the water on in the bathtub. Turn the water on and see how the water pressure is. That helps you. If it's low water pressure in certain bathrooms and it's high water pressure in certain bathrooms, that could be a plumbing issue. When you're in the living room, like, not stomp hard. This ain't like stomp the yard or nothing, but stomp down a little bit on the subfloor to see if you could have like a squeaky or an uneven floor, and you possibly could have a subfloor issue. Those are things I would look out for, especially if you're getting a resale home. If you walk into a basement and it's done, but you're like, hey, this looks like a done basement, but it just seems like the quality of craftsmanship is not there. Go look that address up with the city and see if they ever got permits to complete that basement, and then ask the seller to provide you with any permits they did to complete the basement. Because if they hired just some Joe Blow to do some things and it wasn't permitted work on a basement, it's hard to record that actual square footage. So now the square footage is not recorded with the city because it was never recorded. So you can't even use it for your value appreciation, and you want to check behind the work. Those are things that you can easily do on your own when you're looking at property.
You spoke about this, and I think it's probably one of the most important pieces of the process. People overlook it. They don't really, adequate enough money toward it, and that's the closing costs.
Oh, yeah.
Talk about that, the time it takes, what you should be doing to prepare for it, the best strategies when getting to that point. Because again, this is something that if you're not in this process and you never get to the closing point, you really don't have a good idea of what it takes.
This is what you should do. If you know that you want to buy a house and it's $500,000, you need to calculate. So let's say you're getting a conventional loan. So go ahead and calculate 5% of $500,000. That's your down payment. And now calculate 3% of $500,000. That is your closing cost. Then calculate, don't forget, another 3% for buyer's agent compensation. You are now responsible for that cost. Now, I don't want to scare you. 99% of sellers are still paying buyer's agent compensation because because it has been embedded in them and they want to get their property sold. But buyers need to know, based on that new lawsuit, that is your responsibility. So 5%, 3%, 3%. So if I were you, I would calculate 10% of whatever our purchase price to be, and that is the amount of money I need to have saved. That's what you have to have saved. That's including all of the expenses. And then think about it as a plus if you save on that dollar amount, because now your agent has advocated for you and now you don't have to pay a buyer agent compensation. That takes away 3%. And they're able to get 1.5% from the seller towards your closing costs. Now you're up 4.5%, but the money is still in your bank account. Good for you. Now you have some savings. But don't go into buying a home thinking you don't need any money. We used to say that, and we used to do that, and times have changed. This is how to buy a house in 2025. This is not how to buy a house in 2020 during the pandemic. This is completely different. And so you need to be financially prepared.
Another thing that people don't really fully comprehend, especially like I said, if you just come from an apartment, is furnishing the home, right? Interior design aspect.
Oh my goodness.
So so obviously, that's going to depend on how big the home is, your taste, and then, of course you can move some stuff in. Even that's an expense moving, but you got to move some stuff in. But if you move it from like an apartment to a home, you're going to have to buy some stuff. You're not going to be able just to fill a whole home with just a 1-bedroom apartment furniture. So what should they expect? And what's some best practices as far as, furnishing homes?
We don't want to get into more debt, do we? We don't, right? And I mean this, like, you don't want to get into more debt. On average, to furnish a home, and it's just like an average home, you could use Wayfair. Amazon has all these things, great products. You got a lot of different places you can go to.
Raymore Flanagan.
But even if you go on the lower scale for a 3,000 square foot house, furnishing it with a kitchen table, chairs, couch, televisions, owner suite, king size bed. You can do twins or maybe queens in the other one. So it's $25,000. That is on the lowest end. And if you know what your furniture looks like, who wants to put a very small love seat in the middle of a 3,000 square foot living room with two-story windows, right? You're going to have to account for that. I think we just need to save for home ownership and stop. I don't want it to be like, it's easy peasy. It can be easy peasy, but you should save for it. And if you're responsible and you want to get like different accounts with these furniture companies and you feel like you can pay off the debt and this debt is going to help you and you want to consider it positive debt, then finance the furniture. But I wouldn't recommend it. I'd rather have the money saved to buy the furniture outright. So you, again, are not putting yourself into more debt. So you do have to furnish the place. And I know you've seen that expense. I keep up with y'all renovation.
You watching my stories?
Just know. I get the marble floors.
But that's important though, right? And sometimes relationships is important that can help you in this process, right? Sometimes having people that work in real estate, they have trade accounts, and if you have a trade account, then you're gonna get 20% down. I know that for R&H, like even now, like you can pay toward that, and now you're a member and you get a trade account as just being an individual. So there's some ways, but again, 25. That's a real minimum if you're trying to furnish something 3,000 square feet. Yeah.
Exactly. So we have to prepare for these expenses. I've seen the videos where people walking into these empty houses, like I used all my money on my down payment and I'm sleeping on an air mattress. It should still be an accomplishment. If all you have is a bed and now you have purchased a home that you can afford and you're able to make enough money and you're making enough money to save and then spend a certain amount and take your time to furnish the place, take your time. Rome wasn't built in a day, and you don't have to build your house in a day, but you do want to be realistic about how you need to live as you're purchasing these assets.
Yeah, I think you could definitely furnish a 3,000 square foot house with $20,000. But the thing is, so it's also all right. So we painted a very discouraging picture for home ownership, but it's a realistic picture. But I think, from my philosophy, I think this speaks to the point of going down. Is helpful for the average person. Meaning, if you get approved for a $500,000 mortgage, try to buy a home for $300,000 because you're going to have all these other expenses. And as we say all the time, you don't want to be house rich and cash poor. And that's something that I saw firsthand when I was a financial advisor. People cashed out their 401ks. Literally, they have no money and they had spent every dollar they had to buy a home, just to buy a home, and then all this other stuff. So that's a trap for you to have debt for your whole entire life. And that's not a pathway to financial freedom. So that's just important for people to keep in mind. Like, just because you get approved for something, that doesn't mean that you have to go to that same amount, right? Like, you can go lower than that and then have excess money to do all of the renovations and buy furniture and pay, the taxes and all that stuff, as opposed to going up to that max, liquidating all of your savings, borrowing money, and then you're in a home. But as soon as something happens, then you're screwed. But then I gotta ask you this too. Well, you want to say something?
Yeah, I'll say this. It depends on how you see the value of home ownership. Like, I worked for a corporation when I purchased my first property, and I did take money out of my 401k. But I didn't take all of my money out of my 401k. I leveraged it towards the down payment of a property, which subsequently became a rental property for me. And then, like 6 years later, when I finally did sell that asset, I made about $160,000 on selling that asset, which was pennies compared to the $19,000 I took out of my 401k at the time. So being smart, but that asset was actually less than $200,000. Now, that was obviously a long time ago, but that goes to show that when you're looking to buy your first property, if you're keeping up with your own budget, you understand your entry and your exit strategy, and you're buying this property to, one, build your own internal wealth, and you no longer want to rent, you understand the value of home ownership, then use a portion. I'm okay with using a portion of your 401k, but you don't wipe it out trying to buy $1 million property that you know you cannot afford. That is what happens. That is why that's what normally happens when people are buying a property. It's like they're trying to get something they can't afford to flex on people that don't care. Like, you should be only flexing on yourself. And if you are proud of yourself and what you've purchased, I don't care if you're sleeping on an air mattress. Be happy that you purchased an asset, and then you're leading your way and you're working your way towards wealth. The hardest thing for most people to recognize is the houses that you see that are the things that you want to see. That's like, wow, that's a beautiful house that gets the most likes on social media. That's not going to be the house you buy and you live in. There are people that are making the millions of dollars that refuse to buy those type of assets because they see it as liabilities at that point. They're only buying certain things within a bare minimum of their budget, of their income. So stay within your own budget, and then you'll be just fine with understanding the value and seeing the value in home ownership.
And then I got to ask you this before we wrap this, is that for people, you're a real estate agent, right? Mm-hmm. So for people that are saying that they don't need a real estate agent because they're going to save money that way, or they want to negotiate real estate agents' prices. So what's the commentary for that?
I think that you have to assess the risk. That's how I feel. Assess the risk. If you want to work with an agent, there are agents out here, and there are different companies that have flat fees. That basically means you kind of they just do just enough to keep you within, to tell you what you should expect on the contract, and you can negotiate a flat fee. As a buyer, I have had this happen to me a lot because I represent a lot of sellers. And so they'll come and say, well, I don't have an agent. And so therefore they think that they're going to save money. So the way that I do my listing agreements is there's a fee that I'm going to get paid regardless. So they come in, they negotiate their fees, they advocate on their behalf, and now there's a delay, or let's say they're asking for certain things during the home inspection period. Well, they're asking me, how do I read this home inspection, or what should I ask? I'm sorry, I don't represent you. I represent the seller. You are a customer. Tell me what you want me to ask them. That's how it goes. Tell me what you want me to ask them. I'm not here to advocate for you. I don't represent you. When I'm representing the buyer, my job is to protect your best interest and save you as much money as possible. When I'm representing the seller, I'm there to advocate their best interest and make them profit the most money as possible. So if you feel like you're savvy enough to understand these contract laws and what you read, then try it yourself. I can say 9 times out of 10 it doesn't work.
Is it a conflict of interest if the agent represents the buyer and seller?
I do it all the time. It's called dual agency. It's allowed in the state of Georgia, where the seller is going to be my client and the buyer is my customer. I'm always fair, but when it comes down to it, I'm advocating for the person that hired me and that's paying me the compensation, which is the seller. And that's what normally happens a lot. So when they're coming saying, hey, I'm going to save you some money. And then they're like, well, what's going on in the contract? The way I broke down due diligence periods, financing contingencies, nobody's breaking that down to you. I hope that you know what those periods are, because if I'm representing the seller, I'm going to make sure that by the time if you submit your inspection a day after the due diligence period, I'm going to tell you, sorry, thank you for providing us with this. However, your due diligence ended yesterday and we don't have to make any changes. You want to terminate? You can terminate. We're going to retain your $25,000 earnest money. I wish you the best on your home buying journey. That's how it goes. So you're not saving, but you only, assess the risk.
Assess the risk. Here's one of those things, and people get this confused, right? When we think about real estate, we think about our pathway to home ownership. People will sign the title. Some people end up on the deed. Talking about the difference between the two, because there is a difference. And if you end up on one or the other, it could determine a lot of things in your future.
Well, what happens is this: people always want to be on the title and the deed. When you're buying the property and it's in your name, right? You finance it through the mortgage company. You get it all financed. You're going to be on the title. That's how state of Georgia is. You're going to be on the title and on the deed. But let's just say you're married and the wife is not on the mortgage, but the wife wants to be on the deed. Like Tyler Perry say, make sure your name is on the deed. Cool. You add the wife to the deed. The benefit is, if you cannot sell the asset without both people that are on the deed signing off, you cannot sell it. But let's just say you go into foreclosure. Both people that are on the deed are now in foreclosure, even though the person that's on the deed is not on the mortgage. So the upside is, okay, I'm going to make sure I'm on the deed because he ain't going to make no changes without me. Forget that. That works. But then if a negative change happens, it also affects you negatively as well. So consider that when you're adding yourself to the deeds. It's like you do have the responsibility, as long as the mortgage is in good standing, it doesn't show up on in your name. And that's how people try to kind of house hack marriages. I don't know how to explain it, but like offset the debt. So like the husband can buy the primary property, the wife can buy the secondary property, and it's offsetting the debt. But in the event there's a foreclosure or bankruptcy, everybody on that deed is responsible.
So, okay, it's a lot of information, valuable information. And then, like I said, I think we kind of, it's realistic, but I don't want to discourage people from buying a home because it is still, a valuable asset that goes up over the course of time as long as you buy correctly. But it is important to buy correctly, and it's important to actually use professionals so you don't make mistakes. Using the wrong lawyer, using the wrong real estate attorney, using the wrong anybody that's in the process can actually cost you hundreds of thousands of millions of dollars of mistakes. So, as far as you actually are in the field, so I would say the last question I would go to, how can somebody know if they're using somebody that's good as far as a real estate professional agent? Obviously, they should use you if they're in the Atlanta metro area. And I'll let you say your information, but what are some things that you should ask a real estate agent or somebody in your profession to know, like, this is the person that I want to work with?
I think oftentimes we're going too quickly. If I was a buyer in this market and the agent that wanted to represent me on the largest purchase of my life didn't have the time to sit down with me and explain to me the purchase and sale agreement, which is something you're going to see this as you're writing offers. You may write 4 different offers on 4 different houses. And if they've never explained to you the simple purchase and sale agreement and the contingencies and the timelines in your state, whatever your state is, your agent should be able to tell you at what point do you get your money back or what point do you not get your money back. So you're very aware of the contingencies of the agreement. Then they also need to have an understanding of appreciation value. So whatever area you're looking to purchase in, they should be able to tell you what the appreciation values are in the area and what the market trends are in the area. That way you're actually going into an area where your asset is going to appreciate and you're going to see more value. They should know that. And then beyond that, you should make sure they don't have what we like to call commission breath. And it happens all the time. Someone trying to force you to hurry up and make a decision because they need the commission. We are all salespeople, but we should be advocates for our clients. So you should feel like they're advocating on your behalf at all times. Actually, as a buyer, fighting to save you money and showing you the proof of them trying to save you money. Emails, text messages, advocating, letting the seller know who you are, why you deserve to get this concession, what's wrong with this property. Getting a master negotiator is so important because it saves you thousands of dollars, because I can tell you sellers are not just going to give you anything. So you should look for all of those qualities when you're looking to hire an agent and ask them, can you show me your track record of sales? Like, what is your track record of sales? I think it's okay to ask that question and look them up. I always tell people, you can Google me. Forget social media. You could go to Google and you can see my reviews right there. What other people say about you is more important than what you say about yourself. And I just wouldn't trust someone that I didn't feel like had my best interest at heart. I know they're getting paid, but they're getting paid to perform a service. And that service is to advocate on my behalf, save me money, and get me in an asset that is going to be a positive asset for me.
AKA Quiana says she popping in real life, y'all. Like, we ain't got but you know what? I'll end with this. A lot of people, and we run to a lot of people all the time. They look at real estate as the place that they're going to go when their career, may not be something that they thought it would be. I'm going to get into real estate because they think it's a way to make money, and they think it's an easy way to make money. I've seen you work. I've seen your agents work, the amount of dedication that y'all put into it. What's your advice for people getting into this space? What's the misconceptions that they should know?
Oh, and like MJ says, Quiana, it's your fault. It's your fault. You floating in the room. You're wearing jackets on your shoulders. I'm doing it right now. I will take full responsibility. I'm a glamour person, whether I was selling real estate or whether I was working at the McDonald's drive-thru. This is who I am as a person. But the knowledge that I have about the market, my invested interest in understanding real estate in all facets of real estate, that is something that you want to have when you get in here. 75% of agents last year didn't even close a deal. They're leaving the industry because the influx of people that came when we had the pandemic, and what happened was there were more buyer demand, interest rates were low. All you had to do was post a picture with your arms crossed and boom, you could get a client. And everybody was just trying in a frenzy. Now it's like the cream of the crop is coming to the top. And because of that, if you want to get into this industry, take it seriously. Know that it requires way more due diligence, way more negotiation skills than it did before. And it's not something that I would say would be, I'm getting into real estate because, this is my way out of where I'm at. When if 75% of licensed real estate professionals that actually closed a couple of deals couldn't close a deal last year, I hope that you come into this industry with a different mindset that I'm ready to serve the best interest of people and advocate on their behalf and understand the contracts, and be able to negotiate. Don't come here thinking it's a cute picture and I'm walking around with a Chanel bag and some Louboutins all day. That is just not the reality of what really happens behind the scenes. And if you don't get a good grasp on both, I tell people that social media post is to grasp your attention. I need something. You got to, press the button in my bio. But when you reach out and you go through my assistant and you go through my admin and I go through my onboarding process and I explain the contract, I explain the liabilities of the contract, I make sure you understand exactly what you're getting into. I am like a human computer working on your behalf to protect your best interest as you're buying a home. You can't be a hobby. This can't be a hobby for you. This is people's livelihood that they're investing in. They're using that last 20,000 or 30,000. The least you can do is be educated and make sure that you're advocating for them. So if you want to get in this industry, I don't discourage anybody, but take it seriously.
And how can people find you and how can people work with you?
You can find me on social media. My name is Quiana Watson. You can link in my bio, go to my website, QuianaWatson.com. Everything is Quiana Watson. It's easy to find. Go to my website, click my contact page, call me 404-983-6380. We are ready to work with you. I have my agents here at Watson Realty Co. We work with all price points, all budgets, investors, first-time buyers, luxury clients, listings, developers, you name it, we can service it. So we look forward to you guys reaching out to us, especially in the metro Atlanta area.
Is it outside of Atlanta or just Atlanta?
Oh, no worries. See, I have a training academy of over 1,500 agents throughout the nation. Some are even in Jamaica. I have some people outside of the country, Toronto. So with that being said, no matter where you're looking to purchase a home, if you reach out to me, I can connect you to a licensed agent that has been through my training, that actually understands the process, and they're looking to advocate and serve your best interests. So make sure you contact me for whatever state you want. So I just sent someone a referral to Dallas, one to Miami. I sent another referral to another client looking in Birmingham, and New Jersey's on lock. I tell you, I have to go. The only reason I do my events in DC is the middle of New Jersey. So I always tell people.
You actually got me somebody in New York.
Oh yeah, I forgot. Yeah, I did get you somebody in New York, and they was in my training academy. So yeah.
So you definitely connected. And yeah, Quiana is somebody that, definitely has been A1 from the beginning. So always appreciate you coming in and dropping information. But yeah, if you're in the home buying process or you're looking to rent too, I think you help people out with rent. I think your agents.
Absolutely. Yeah, my agents can assist you with rentals. I think that's a bridgeway. Everybody is not in a position to purchase. Who are we to judge? I think that we all need housing, and that's our job and advocate as real estate professionals, is to give you housing and make sure you understand how that works.
Absolutely.
Or if you're looking to sell your home, you might need help too. So
absolutely. Oh, you're gonna need help to sell it. I'm gonna tell you that right now.
Sure.
You will need help. We represent buyers and sellers. You will need assistance. And mostly, as you guys can see, if you look me up, I work with a lot of developers. They're developing building, which is why I'm pretty abreast of the building process. So even if you're looking to build a custom home or you want new construction, I can assist you there as well.
Yes.
There you have it.
And congratulations on all the developments that we've been watching on social media as well.
Oh, yeah, I know. Oh, I know your wife. I'm aware. I know who's watching and why you're making those design selections. They look good.
Quiana, always a pleasure. All right.
Yes.
Thank you guys for rocking
Yes.
with us, for listening. We'll see you guys back here next week. Hopefully you got your pens and pads and watch this episode a few times so you can get all the information that's important. And download the app for the podcast app too, if you listen on the audio side on iTunes or Spotify. But all right, guys, it's been real.
Peace.
Bye.